Better System Trader, episode 58.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to Better System Trader, episode 58. It's Andrew Swanscott here, and I'm so glad you've joined us today. Building robust trading strategies that can detect and even adapt to market conditions can be a real challenge, and failure to do so can often result in poor trading performance and drawdowns. How can we build more robust trading strategies that adapt to market conditions as they change? Our guest for this episode, John Ehlers, has been on the podcast before. Back in episode 48, we discussed digital signal processing and cycles in trading. And in this episode, John joins us to share some common problems traders face when building trading strategies, along with some tips on how to overcome them. So in our chat today, you'll learn tips and techniques to detecting and adapting to market conditions, some common mistakes traders make with indicators and how to fix them, the 4 requirements to building a robust trading strategy, why the conventional wisdom of using indicators causes late signals and how to use them to anticipate instead, plus a simple technique to determine if your indicators are actually working properly for the market conditions, which is pretty cool. And also, at the end of the episode, I'll let you know about a special giveaway we're holding over the next week or so. I'll tell you all about how to enter for that and the prize at the end, so listen out for that. But before we get started, let's hear a quick word from our sponsor. How would you like to copy the trading as some of the best traders around, automatically taking the exact same trades they take in their own personal accounts? Traders like Michael Cook, Larry Williams, Rob Mitchell, or even John Ehlers, the guest on this podcast episode. Well, you can with worldcupadvisor.com. So for more information, check the show notes page at bettersystemtrader.com/58. And as always, please remember that futures trading involves significant risk of loss and is not suitable for everyone. Now on to our chat with John Ehlers. Hi John, welcome back to the show. It's great to have you here again.
Well, thank you for having me.
Now, you were a guest on the show quite a few months ago now, back in episode 48, and you did give us a little bit of your background back then, but perhaps can you give us a brief summary of your background and how you got started in trading, please?
Sure. I'm an engineer by education. I got my master's in electrical engineering at the University of Missouri, and I did my doctoral work at George Washington University. I got a bonus one year and had to spend it on something, and rather than being a landlord, I decided to start trading commodities. And that's how I got my start, and I've been trading commodities pretty much ever since. I retired about 10 years ago, and I've been spending all of my time in research on digital signal processing for market data since then.
Okay. All right. Thanks. So you've recently had an article published in the September issue of Stocks and Commodities magazine, which it offers some interesting techniques into detecting and adapting to market conditions, which I thought would be great to have a chat about today. But before we get into that article and some of the solutions that you provide in there, can you share with us some common problems that you see traders make with how they use their indicators?
Sure. I think most traders start to use canned indicators like a stochastic or RSI or MACD, and they use them with fixed length with not thinking much about them. They take the length that has been recommended by a broker perhaps, and they start trading them away, and they may have a good run for a while, and then they crash and burn for no explainable reason. And so they lose faith in their technology. And the basic problem is that they don't have a true understanding of the market activity and how to fit the indicators to that activity.
Okay, so you actually start discussing that in the stocks and commodities article that I just mentioned. So perhaps can you summarize some of the major points in that article before we continue?
Sure. The whole idea of the article is a unique way to measure cycles in the market. And it's unique because it accommodates an effect of market data that I call spectral dilation. That is, the longer cycle periods have bigger swings, and that throws off the use of your indicators if you're trying to tune your indicator to the measured cycle. So it's a unique way that avoids the problem of spectral dilation. And then some of the other effects that come into play are digital signal processing problems like aliasing, and that just has to be eliminated for effective algorithmic trading.
Right. Okay. So you mentioned that spectral dilation is that longer cycle periods have larger swings. Can you explain that a little bit more and the type of impacts that they can actually have on indicators and trading strategies in general?
If one looks at a chart of weekly data and removes the labels on the chart and looks at another chart of weekly data, comparing the weekly data chart and the daily data chart, they basically look the same. Well, what that means is that the horizontal axis, the time axis, is enlarged by 5-1. But if the charts look the same and the horizontal axis is expanded 5-1, then necessarily the vertical axis is 5-1. So the implication is that longer cycle periods have bigger swings. If you have real long yearly cycles, they're much, much larger than an intraday cycle, for example. So one has to take that into account in creating, well, first of all, in measuring the cycles, and then secondly, using that measurement in adapting indicators to the best period.
Okay, so I guess some people might say that the smaller time frame charts, like the 5 minute or the 1 minute or even shorter, they tend to have a lot more noise in them when compared to the larger time frames like daily, weekly, or monthly, and perhaps also that strategies that work on those smaller time charts don't necessarily mean that they're going to work on the larger time frames and vice versa. So does that kind of invalidate the idea that market data is fractal?
No, not at all. In fact, I would disagree with the premise. The problem, in fact, one of my favorite time frames is a 15-minute bar. The problem is that the cycle swings on the shorter time-based cycles are smaller. And in fact, when you get down into 1 minute time bars and small sample sizes like that, the cycle swings are so small that the profit that you can expect to make on a single swing is less than your transaction cost. And so you have another paradigm that comes into play that you have to be considering in your trading, which is transaction costs, for at least for us retail traders. And the idea of spectral dilation works all as far out as long as a cycle you want to think of, and all the way down to as short a cycle as you want to think of for sample data.
Okay. Now, if I can just one of the concepts you mentioned in that stocks and commodities article is an application called autocorrelation periodogram, which I thought was a really interesting technique. So, can you explain a little bit about what that is and the concept behind how it works?
Sure. The idea is that you necessarily have spectral dilation in the data, so you have to mitigate the effects of that somehow. If you just take a discrete Fourier transform or even my MESA program, there's no compensation for spectral dilation, and you're going to get a distortion because of it. However, if you think the way of an autocorrelation function works, picture a perfect 20-bar cycle. Autocorrelation, you're correlating that 20-bar cycle with itself. So with zero lag, you get a perfect one-to-one correlation. So the correlation value is a +1. And then if you slip the lag by half a cycle, 10 bars, then the two waves that you're comparing for correlation are perfectly anti-correlated, and that means the correlation value slips to -1. If you increase the lag still further, so it's 20 bars, now the 20-bar cycle slipped by 20 bars is perfectly aligned again, and so you get a +1 correlation. So even though you have dilation, spectral dilation in the data, when you run the autocorrelation function, you get a function that necessarily swings from +1 to -1 and back again and cannot exceed those limits. And so you have removed the effects of spectral dilation regardless of the periodicity of the cycle that you're measuring. So the idea then is once you've established the periodicity as a function of the autocorrelation function, then you take a discrete Fourier transform of the correlation function, and that tells you, that measurement tells you what the cycle periods are, or an estimate of the entire spectrum.
Okay, so let me see if I've got this correct then. So essentially, you're measuring the price data against itself and plotting that into a range of -1 and 1, and then displaying that as a periodogram format. Is that essentially?
That's correct. That's correct.
Okay.
And it's displayed the way I display the information. The vertical axis is the cycle period, and I display the strength of the cycle by coloration. The goes from yellow or white hot, cooling down through red hot, down to ice cold black. And so it's an interesting kind of heat map display that shows this variance of the cycle as a function of time.
Yeah, cool. And people can actually download a copy of that indicator from the Stocks and Commodities website, I assume, from buying the magazine. So if people want to have a look at that, they can get that for free there.
Yes. And if you're a subscriber to Stocks and Commodities, you can get the electronic version of the code and the article itself at website www.traders.com.
Yep. Okay. I'll have a link for that in the show notes so people can get to that. Now, you mentioned a couple of times about the effects of spectral dilation and that it can introduce distortion. But, what does that mean in a practical sense for traders? Like, what is that, how does that manifest itself in trading?
Well, indicators, if you stop and think about it, are predictors of what's going to happen in the future. So if you're trading, say, in a monthly cycle, you're expecting to hold a position for half a month or about 10 trading days. And so you're looking for that indicator not to tell you what's happened in the past, but to give you some advance indication of where the market's going to go in the next 10 bars. So that means that because the data is noisy, that trading is really a statistical proposition. And since it's a statistical proposition, you need to develop a strategy that's going to put the odds in your favor. I think the most robust strategy is one of reversion to the mean, which is basically the same thing as trading the cycle. But you need to get in at the bottom or go long at the bottom of the cycle and get out or go short at the top of the cycle. So that means you have to anticipate the turning point. So conventional wisdom has, say, a stochastic buying when the RSI is crossing above 20 and selling when it crosses below 80. But that's almost the wrong thing to do. It's, in fact, to anticipate the turning point, when you're the furthest away from the mean, you need to buy when the indicator is crossing down below 20 and sell short when it crosses up above 80. So it's almost the opposite of conventional wisdom. To anticipate the turning point on getting the statistical edge on the reversion to the mean.
Okay, so it sounds like you're trying to get a higher percentage of winning trades by using those type of approaches.
Absolutely. There's when you look at the statistical data that TradeStation or Multicharts or any of the platforms put out, among them are your percentage wins and your profit factor. Well, profit factor is the ratio of gross wins to gross losses, or in terms of Las Vegas gaming, that's your payout. So those two factors completely describe the characteristics of your trading algorithms: percent wins and profit factor. So you want to go, in my opinion, for the kind of trade that's going to give you the highest percentage wins. And as I said before, my opinion is that is a reversion to the mean, or swing trading, as it were, as opposed to trend trading. Trend trading, you're looking for a big hit, but you have to take a lot of small bites and get in and get out until you hit the big strike. When you do that, that necessarily means your percentage wins go down. So that's why I prefer swing trading or cycle trading. I use those interchangeably.
Yeah. Okay. So, do you think cycle trading in a trend trading kind of model doesn't work so much, or is it just a personal preference of yours?
Trend trading obviously works because a lot of people use it. However, my opinion is it works because they trade long, and if you look at the market over the last at least 20 years, has gone almost nowhere but straight up. In other words, the bias in the market in general is to the plus side. So if you simply buy stocks and go to the long side, it's going to work in your favor. But if you trade commodities, you have the facility to trade short as well, and you want the higher percentage working on the short side as well as on the long side.
Yeah. Okay. So if you're chasing these high percentage wins, how do you use cycles to do that?
There's several ways. First of all, just using an RSI. The most simple form of an RSI is the sum of the closes up over the analysis period divided by the absolute value of the closes up plus the closes down, and or on all close-to-close values. So if you're looking at an RSI over, let's again assume that we have a 20-bar cycle. If you're looking over a 10-bar cycle, go on the upside from bottom to top, you have nothing but values going up, and so the RSI will have a value of +1. And similarly, on the downside, it goes 10 bars from top to bottom, and it swings from a +1 down to a -1. So that is the most efficient length to choose for an RSI. If you choose a length that's too short, the RSI is going to switch rapidly from one limit to the other and stay there for a while and swing back. And so the indicator will look more like a square wave. If you choose a length that's too long, then the indicator will be an averaging indicator, and it'll just kind of wander around near the middle. So the whole idea of using cycles in this RSI example is to set the right length and do it dynamically as the market conditions change, so that the RSI is actually adapting to the current conditions in the market and giving you the most sensitivity for that indicator.
Okay, so you're using cycles to adapt to the markets, but is there more to it than that?
Well, sure. The market is sample data, and when you have sample data, there's necessarily a thing called aliasing. Aliasing shows itself like in the old cowboy movies when the wagon wheels turn backwards. The movies were sampling at 16 frames per second, and that wasn't fast enough to accurately capture the turning of the spokes of the wheels, so they appeared to go backwards. Or another example of aliasing are dancers using strobe lights. Their movements look otherworldly when they're dancing, and these strobe lights only catch them in the act of dancing ever so often. It looks unreal. So that is a case of aliasing. Since market data is sampled data, that is, you get one sample a day or one sample every 15 minutes or whatever, there necessarily is aliasing involved. And so the first thing in the model that has to be done is to get rid of that. And the only way to get rid of aliasing is by smoothing a low-pass filter, which is a smoothing filter. And that has to be done with some care because you don't want to have too much filtering that takes away the information. And yet you have to have enough that gets rid of that false data that's been folded back into the real spectrum. So I like to use a filter I call the super smoother because it does a good job. And with reference to daily data, I usually set that around a critical frequency of about an 8-bar period. That's about 2 octaves away from the Nyquist frequency at where the folding of the aliasing takes place. So that's one requirement. The other is when you're taking the indicator, you absolutely have to accommodate and mitigate the effects of spectral dilation. I've created a proprietary filter that does that, and it's a fairly simple filter, but it is a mandatory requirement. And this is a filter of the class called a high-pass filter. So you're getting basically throwing away the long cycle periods or the trend components if you're looking for reversion to the mean kinds of algorithms.
Okay, so thinking back to that example you made of the wagon wheel that appears to be spinning backwards even though it's going forwards, that aliasing is actually giving us an incorrect picture of what's really happening there. So as far as trading, are you implying that it's best to use the shorter time frame charts so that we can increase the sampling frequency and therefore reduce perhaps the impact of this aliasing?
It really doesn't help much because the answer is if you really understand digital signal processing, yes, you can use oversampling to defeat the effects of aliasing. But for example, if you're going from daily data to some kind of intraday data, you have to handle the cases of gap openings, and those step functions that occur in the data can wreak havoc with your calculations as well. So yeah, you can do it, but you have to be a little bit careful.
Okay, so what is actually the effect of aliasing on trading? Like, what impact does that have on trading systems?
It gives you false positives in your signals. Right. If instead of the perfect 20-bar sine wave that I referred to, it might have start to go down and then go up before it reaches bottom and then swings back down to the bottom again. In other words, it throws in a false cycle, oftentimes much faster than the real cycle period that you're trying to trade.
Okay. All right. So how else can we use cycles to make robust trading strategies?
Well, one way is an open loop way is first measure the cycles as I have shown with the autocorrelation periodogram. and then take that measured cycle period and apply it to another indicator. For example, if you're using an RSI, you might want to try using half the measured cycle period for the length of the calculation used in the RSI. Mm-hmm. That makes your RSI indicator dynamically tuned to measured conditions. It's still that's an open loop situation, and you have some lag because you first measured the cycle, and that's based upon historical data. And then you apply that to an indicator which also has lag. So you must be aware that you must anticipate those turning points also, even though you're dynamically tuned to the measured cycle.
Okay, so if you do know, or if you have measured the cycle length, how can you go about anticipating that?
Well, conventional wisdom has you waiting for confirmation. After your indicator tells you that the market has turned up, then you make your entry. Mm-hmm. That's almost exactly the wrong time because of the lag in your calculations. You've already missed the turning point, and if your typical examples, if a filter might have, the smoothing filter might have 3 bars of lag, and the RSI might have, say, 3 bars of lag. You can't get into the trade until a bar after the signal comes. And then if you wait for confirmation of another 3 bars, say, the sum of that is 10 bars relative to the real bottom of the cycle swing. Well, 10 bars is actually the top of the next cycle. So if you wait for confirmation, you're getting in at exactly the wrong time. On the other hand, if you anticipate the turning points, you still have the 3 bars of lag of the filter. You still have the 3 bars of lag of the indicator. You still have to wait 1 bar to make your entry after you get the signal. So that's a total of 7. But if you anticipate the turning point by 3 bars, you are net 4 bars after the turning point. So you get in time to make the most of the upward move after the turn has occurred.
Okay. Right, we're going to take a really short break here for a message from our sponsor, but just after that, John's about to tell us a really simple way to determine if our indicators are actually working properly just by looking at them. And then a bit later on, we'll also share details of a special giveaway for this episode, so listen out for that right after this message from our sponsor. Are you interested in trading using Mesa cycle analysis but aren't really sure how to do it properly? How would you like to copy the trades that John Ehlers takes in his own trading account? WorldCupAdvisor.com lets you do exactly that, and with the launch of John Ehlers' new Mesa Ultra ES program, you can now join John and add Mesa trading to your own portfolio. John has his own money on the line right along with his subscribers on every trade he makes in his account. World Cup Advisor identifies futures and forex trade leaders through rigorous screening, including live trading evaluation in the World Cup Trading Championship competition, and enables subscribers to mirror their trading buy for buy and sell for sell. As a subscriber, if your fill price is not equal to or better than your lead trader's fill price on any trade, the trade is commission-free from your authorized broker. There are more than a dozen futures and forex programs to choose from, and you can view complete actual performance data before subscribing. To learn more, check the show notes page at bettersystemtrader.com/58. And as always, please remember that futures trading involves significant risk of loss and is not suitable for everyone. And back to our chat with John. And what about if a trader doesn't know about cycles or how to measure them? What are some techniques that they can use to determine if their indicators are working properly or to improve the usefulness of their indicators?
Well, if you're using a stochastic, one characteristic of a stochastic is that if you're in an uptrend, the indicator will tend to be stuck near the upper limit for long periods of time. And that frankly is just an artifact of spectral dilation. That long cycle component that's in there in the trend component is driving that indicator to the upper limit and holding it. And conversely, if you're in a downtrend for a long period of time, the stochastic will get stuck against the lower limit. So the first technique is you must use a high-pass filter of some kind to get rid of spectral dilation. I recommend a two-pole high-pass. I've written about that in my books, and people can find that. It just simply eliminates the longer trend components so that your stochastic will swing back and forth according to the short-term variations of the cycle of interest. And mostly for daily traders, that might be a monthly cycle. And the other case I mentioned, if you're using with an RSI, you can start with too long a period that's knowingly too long and just keep shortening it up until you get good sensitivity swings out of your indicator.
Okay, so that's interesting. So you can really tell just by looking at how the indicator behaves whether or not it's tuned to what the markets are doing.
As Yogi Bear said, you can see a lot just by looking.
Okay, so do you have any other considerations in making robust trading strategies?
Well, I put them in form of requirements. I think there are 4 requirements that must be obeyed to have a robust trading strategy. And we've touched on them quite a bit today. The first requirement is that the effects of spectral dilation must be mitigated somehow. Quite often that's done with a high-pass filter. Secondly, the effects of aliasing must be completely removed, and that's usually done with a smoothing filter, a moving average, but I recommend a super smoother because it does a better job of filtering. The third requirement is that the computational lag of the indicators must be minimized. You can't have a big complicated filter. Because once you introduce lag in your computation, you're not getting it back. That's like a picture. Once it's out of focus, you can't refocus the picture back again. So keep a low lag indicator as low as lag as possible. And then finally, the fourth requirement is that every possible effort to increase the signal-to-noise ratio must be made. And you can do that with some digital signal processing techniques. It gets a little bit into complex variables, but minimizing the signal-to-noise ratio using the available information is the best way to do that. And finally, just the style of trading is important. I recommend mean reversion because trading is a statistical process, and and we've covered techniques to throw the odds in your favor when you're doing mean reversion.
Yep. Okay, thanks, John. So we've covered quite a bit of info here today, but what about people who want more? What do you recommend they can do?
I would like to recommend a workshop that I'm holding here in California on October 28th through the 30th, a 3-day intense personal one-on-one workshop. It's going to be a very small group, and I'm going to share everything I know about technical analysis in that workshop. I'm going to disclose my MESA algorithms. I'm going to disclose the code for my MESA phaser and MESA intraday programs. And there's a difference between commercial programs and programs that I could write for myself. And so I'm going to disclose a number of both daily trading strategies and intraday strategies that are probably better than my commercial products, and the ones that I actually use in my own trading.
Okay.
So, but most of all, I'm going to spend almost a whole day on just the character of the market and showing folks what not to do, what the things that conventional wisdom would have you do, and show them not only that it's wrong, but why it's wrong. And from that, we can build up what's right and how to build convincing models that builds robust strategies. And the emphasis is on robust. Anybody can show you an equity curve that's wonderful over the past 10 years. But it takes a lot more to build an equity curve that's going to be straight for the next 10 years. And that's the whole idea of robustness, is to throw the odds in your favor and have an equity growth that follows the statistical process.
Yeah, okay. So where can listeners find out more about this workshop?
Please go to my website, mesasoftware.com, and scroll down from right on the homepage. Just scroll down, and you'll come to the first page you come to under the homepage is the workshop description.
Yep, okay. Now, I know you have a list of indicators and strategies that you'll be disclosing on your website there. I don't have it up at the moment, but can you give us a little bit of a preview on that, please?
Okay, I've got my list right here. I'm going to talk about most of the indicators I've published and in one form or another, but I will be giving the easy language or power language code to every one of these indicators and trading strategies in a thumb drive to all the attendees. I've got intraday, I've got, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 different daily strategies of different approaches, measuring the angle and phase angle and so on. And I have a total of 7 different intraday strategies that work on 1-minute bars, 5-minute bars, 15-minute bars, and so forth. So it'll be a good across-the-board collection of effective and robust trading strategies that I'll be presenting.
All right, and the code for all of that is completely open, right? There's no hidden code?
Completely open.
Yep.
And in easy language format.
Yep. Okay, cool. Now, people are probably wondering how much it costs, so can you share what the cost of the workshop is?
The cost is $6,000. And while people catch their breath, I know it's pricey. And so I guess the first question is, why does it cost so much? And the answer is simply because it's worth it. Many of the strategies that I show will have income of over $10,000 a year per contract, say on the E-mini S&P, on hypothetical backtest. So if you trade several contracts, you can earn the fee of the course back in a really short order. And by the way, there is a button on my website to place your order through PayPal. PayPal does all of my signal processing, and so in the PayPal order form, please include a note that you heard about the workshop via this interview with Andrew.
Yeah. All right, thanks, John. I'll include some links for that in the show notes page for this episode as well, so that it's easy for people to find. Now, is there anything else that you'd like to say before we wrap up for today?
Well, I recognize that a number of people don't really have the facility or the background to do their own coding or build their own trading strategies. And so I would like them to visit World Cup Advisors. I have a leader follower program there that trades the E-mini S&P intraday. It trades 15-minute bars. It trades typically once a day, maybe twice a day sometimes. And in the leader follower program that World Cup has, they can get my exact same fills. The technology advanced so that I have the trading strategy in a virtual computer in the cloud. And so the things that developers worry about are single point failures in terms of loss of the internet or loss of power and so forth. That's avoided. And the trades go directly from my virtual computer to World Cup Associates, and they place the trades for everyone, and everyone gets exactly the same fills. And it's intended for those that want to trade, but are more inclined to follow my trades rather than developing their own trading systems.
Yep. Okay, great. Thanks. And I should also recommend that people take a look at the Stocks and Commodities article, September 2016 issue. We did cover some of it in our chat today, but the article goes into much more detail. And as we mentioned, you can also download the easy code language for the autocorrelation periodogram for free. So it's interesting to attach to your charts and get a visualization of the cycles being detected in the data. And also you've kindly offered a copy of your new book, which we'll be giving away in a giveaway. So I'll provide some more details about how you can enter that and possibly win a copy of John's new book just after the chat today. So thank you very much for that, John. That's very, very kind of you to donate that.
And you're welcome, Andrew.
Okay, so thanks a lot for your chat today and for sharing some of your insights with us. And I'd just like to wish you all the best for the future.
Thank you kindly, and look forward to seeing you soon. Bye for now.
Cheers, bye. A big thanks to John for taking the time to chat with us today. If you're interested in learning more about what we discussed, we have some additional information and links on the show notes page for this episode, including a link to John's article on stocks and commodities and also links to more information for the workshop if you're interested in that. So head over to the show notes page, bettersystemtrader.com/58 for more details. Now, as we mentioned at the end of our chat, John has kindly offered a free copy of his latest book, Cycle Analytics for Traders, Advanced Technical Trading Concepts. The book is valued at $135, but you have the chance to win it for free. So for more information on how to enter the giveaway, it's really simple. Just go to the show notes page at bettersystemtrader.com/58 and click on the image of his book to enter. The winner will be drawn on the 26th of September, so get in quick, make sure you don't miss out. Anyway, that's it for this episode. I hope you enjoyed the chat with John and found some really interesting ideas for your own trading strategies. Don't forget to enter that draw to win a copy of his latest book, and we'll catch you again in 2 weeks. Thanks for listening to Better System Trader.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.